Today on Mark Talks Finance, we're going to be talking about using a line of credit to pay off your credit card debt and whether or not this makes sense. Let's get right into it. So if you're in an unfortunate position where you have a high credit card balance and you see that the bills are piling up quickly, you may think about resorting to using one credit card to pay off another. Now, a lot of people do this, and this is also known as credit card churning. But in reality, this does not actually move the debt. It only gives the illusion that the debt is actually being paid off, even though you're just using one card to pay off another. Because in a lot of these scenarios, you're just stuck making the minimum payments. Now, a great answer to resolving this issue of high interest credit card debt is by using a line of credit strategy to pay off your credit card debt. Now, this has quite a few advantages, but there are a few things you need to consider before you jump into using this strategy, which we're going to discuss in detail. So if this sounds interesting to you, let's get right into it and we'll talk about it. Now, like I mentioned, a line of credit is a very useful strategy to help put that debt in your rearview mirror where it belongs. But exactly what is a line of credit? Well, quite simply, a line of credit is a predetermined loan amount that's given to you that you can either pay off all at once immediately or over a set period of time. Now, this differs from a credit card, in which a credit card works that you rack up the debt and then you pay it off after. A line of credit has a given set amount that you draw down from and you pay off over time, or you can pay off the balance in full. Now, this is a very powerful tool because, like I mentioned, there's a defined amount of money that you can then draw down from, and the interests are usually much lower than a credit card. And this is the key to the line of credit strategy, to ensure that the interest rate on your line of credit is lower than what you currently have on your credit card. And the lower, the better. So picture this. Let's say you were owing $10,000 on a credit card at 20% annual interest. You would pay $2,000 over the year in interest for a total of $12,000. But let's compare this to if you had the same amount, which is $10,000, on a line of credit with an 8% interest rate. You would only pay $800 in interest over the course of a year for a total of $10,800. Now, when compared to the amount you pay on a credit card, this saves you over $1,200. So quite simply put, the lower the interest, the more money you have available to you that could roll over into paying off your credit card faster. So, how exactly do you go about getting a line of credit? Well, like I mentioned, a line of credit is a predetermined loan, and you can actually get this from your financial institution. A lot of financial institutions actually allow you to apply online now to get the process rolling, see if you actually qualify for a line of credit. If you have a good credit score, however, the financial institutions will actually save you the hassle of applying online, because they will actually come to you with an offer for a line of credit, at which point you can choose either to accept it or reject it, depending on your situation. But I assume that since you're watching this video, you most likely are looking for a way to use your line of credit to pay off your credit card. So if they do approach you, you can go ahead and accept it. As long as you have it, it doesn't really matter. It is something that's nice to have in case you need it. If you don't feel that you need it right at this moment and you get offered, it's not a bad idea to accept it, just so you have it when you actually do need it, and you don't have to go through the process of applying when you actually find out that you all of a sudden need it after all. Now, the details of the steps to apply could vary according to financial institution, but in essence, once you qualify, you get the amount and you're good to go. One thing to note is that the higher your credit score, the better rate you will get on the line of credit. Keep in mind that you want to keep your credit score as pristine as possible when you apply for the line of credit. So before you apply, make sure that you don't have any outstanding loans, and make sure that prior to applying, you ensure that you're paying off any bills on time. So no late payments. Also keep in mind that the higher your credit score, the better interest rate you will get. That is, the lower interest rate you will get on your line of credit. Remember, a lower interest rate is always a good thing. So keep your credit score as pristine as possible. So to summarize here, you want to have a good credit score. Make sure at least 690 and above. You also want to have no late bill payments, and you want to have a good record of paying back your bills on time. And you also want to ensure that you have some cash on hand to show that you have cash to pay off your line of credit if you need to in a pinch. Now, once you secure the line of credit, it will be available for you to use as much as you want, provided you pay back at least a minimum payment every month. So shop around at financial institutions. Typically, credit card interest rates are around 20%, but you can get a line of credit interest rates at around 5 to 8% or even lower. Please bear in mind that this can vary from location to location, so definitely shop around to see if you can find a deal that's best for you. So the strategy here is, once you have your line of credit secured, you want to use your line of credit to pay off your credit card balance in full. Since the line of credit has a lower interest rate, we're essentially using that and making that our main focus of debt repayment, because this is a lot more forgiving than a credit card balance. So once you've withdrawn from your line of credit, feel free to use that amount to pay off your credit card in one shot. It's a good feeling when your interest rate goes down from 20% to under 10%, because that gives you a little bit more flexibility and just lifts the weight off your shoulders so you can actually focus on something that you have a better chance of paying off. Word of caution on this though, while you're going through this whole process, please refrain from using your credit card. The whole purpose of this exercise is to get you one step closer to being debt-free by clearing off the debt on your credit card. So once you've transferred the balance from your line of credit and use that to pay off your credit card, ensure that you are not making any new purchases on your credit card. Instead, you should be focusing on paying off your line of credit. And if there's anything that you can't pay off using your debit account, then it's probably a good idea not to buy that thing. So the bottom line is this: a line of credit is not a replacement for your credit card. I'll repeat that again. A line of credit is not a replacement for your credit card. It is, however, an efficient tool that could be used to deal with debt. However, the most efficient way to deal with credit card debt is to ensure that you don't have any to begin with. And with that said, that'll bring me to the end of this video. I hope you found a lot of value out of this. Please let me know if there's any questions regarding this strategy, or if you know anyone that has used this strategy, or if you found this strategy to be helpful to you in the past. Please comment down below. It will be much appreciated. Drop a like down below as well while you're at it. I really do appreciate it, and it really does help out the channel. That's it for now. Thanks for watching, and I'll catch you in the next video.